A very, very warm welcome to all of you and a very, very good evening for today's class. So this is CA Ridhima Bhatia and we'll be doing today Profits and Gains of Business and Profession, your chapter 6 of module 1. So again, before we proceed ahead, in the last class we did income which are exempt, which is your income which do not form part of your total income. So apparently we have done all the sections which were there. Any doubts meanwhile if you have for the previous class, we can take it up before we take up this new chapter. For today's class, please be handy with your calculator, a small notepad, and please try to engage as much as you can so that we can have a healthy conversation, because this offline and online barrier actually let's try make it more fruitful by having more doubts from your side and more participation. Thank you. So again, before we proceed, any doubt of the previous class? Students, one more thing. I think in the previous class, one thing which was left was about, remember for getting the reduction post 10 years, that is from the 11th assessment year, you need to transfer your profits up to 50, you will get 50% reductions of the profits, provided the same is being transferred to a special reserve. So the utilization of that special reserve was not discussed. For the utilization, you have to utilize that amount which is transferred to the special reserve within 3 years from its transferring, and you have to utilize it for new plant and machinery. When I say new plant and machinery, it should not be a second-hand plant and machinery. And also, if you have not utilized it within this 3-year period, or if you misutilize it, misutilize means that you did not purchase the plant and machinery, or you distributed such profits because these are in your reserves and you distributed it to your shareholders, or you purchased something else. So in that year, it would be treated as your income, deemed income. Okay, so this point was left. Apart from that, any questions or any feedback so that we can take care of it in the today's class? Hello, great. So now let's begin with our today's class, which is a very, 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 very important chapter, PGBP, which is commonly called as C students. This holds a great weightage for your exam purpose. A good assessment question can come from this. You may know math, but if you do not know PGBP well, your whole assessment question can go left, right. Okay, so says, and otherwise also in practical life, if you will be practicing as a chartered accountant, if you want to be an entrepreneur, you should have the knowledge of this chapter. To understand this chapter, I would request everyone to understand as if you are conducting a business or a profession, so that you can relate it in a much, much better way. So now this chapter is called as your profits and gains from business or profession. When I say business or profession, what do you understand by that? When I use the word business or profession, what one understand this from this? So students, business or profession may, when I talk about, business is something which is defined in my Income Tax Act under section 2 clause 13, okay, which says it is an any activity involving trade, commerce or manufacturing. There's trade, there's commerce, or there is manufacturing. But profession is nowhere defined. But when I say profession, I understand that it involves some degree of application of knowledge or application of learning. So you basically require some degree or some specific knowledge or some specific learning or skills to perform that. So even from a sculptor to an accountant to a legal practitioner, everyone comes in profession. Correct? And when we say profits and gains of business or profession which is being conducted would be charged under this head. Obviously, we all know that there are five heads: salary, there is house and income from house property, your PGBP, then your capital gain, and your other sources. So under this head, now each head has its own charging section. What is charging? What do you understand by charging section? Charging section is a section which tells what type of income will come under this head. So this head has a charging section under section 28, which enumerates various type of incomes which will be taxed as my PGBP income. Okay. So when again coming to the term profits and gains, when we talk about profits and gains, obviously we talk about business related profits and gains. These profits can be in cash or money worth, that is, can be in kind. But obviously we do not include here your capital gains, your capital receipts. We do not include here your capital receipts. Also, if you're into some illegal business, then also income tax says that we are not into legality of your business. We want the gains to be taxed, so you have to tax them. Apart from that, one thing you have to take care of, a question, a case study, anything can come, is voluntary receipts are also taxed in your PGBP income if they are in relation to your PGBP. What do you mean by this? See, suppose I am a lawyer. I was fighting a case. I was actually representing a case for X party. But because of my efforts, Y party also got benefited. Now, Y party is not my client, right? But Y party gave me something as a out of gratitude that we were benefited so and so much, so this is for you. So that token, whatever they have given to me, even if they were not my client, would come as my PGBP income, because this has come out of profession only. Clear? Also, one thing, students, each type of business would be shown separately, as in profit from business 1, profit from business 2, profit from business 3, and then all of them will go in my PGBP head. Now, since we all know this is a huge chapter and we have good classes dedicated to it, so just to give you a rough understanding of how we will be going throughout this chapter, so that you can relate much, I'll be beginning with your section 29, which tells you how to compute profits, and then to all the deductions from section 30, 30, 31, 32, and so on, 35, 36, 37. These are very, very important. Then I'll go to your inadmissible deductions under section 40. Side by side, we'll be doing section 41, and then at the end we'll be coming to your theoretical part, which is your 44A, AD, presumptive taxation, all of these, and then at the end I will approach to ICDAs and the whole list of section 28, because at that time you'll be able to relate in a much better position, and speculative income. So this is how we'll be doing. Today's class would be obviously majorly dedicated to depreciation, and we'll be again doing questions in relation to them, which are there in your module. I will request each one of you to, after the class is over, practice the question, make yourself small notes, read case laws. Do not practice just questions from the module. Try practicing it from RTP's paper, so that you can close that chapter once and for all. Yes, Sumit, teaching is covered under business and profession. Okay, now what and how do we compute? Section 29, which is my section which tells me how to compute the profits and gains from business or profession. This tells me how do we compute it. Now, students, not going into the core technical language, in the paper or otherwise also, when the practice, in the real life practice, you are given net profit, which is obviously as per the P&L, and if it's a company, as per the Companies Act, or if it is any particular financial entity, then as per their respective act. Correct? You are given this. From this net profit, which is basically the profit which is in the books, you have to come to the profit as per the income tax. Correct? Now, this is one common, very common, and this whole concept and whole calculation is based on very common understanding. Whatever expense which is included or which is net off in this net profit and is not allowed as per my Income Tax Act. That means you have reduced your net profit, but it is not allowed as per my Income Tax Act. I will add those expenses which are not allowed. Correct? At the same time, I will reduce the expenses which are allowed as per income tax but have not made any impact in my net profit. What is my net profit? Turnover less all expenses, but before distributions of dividend. So please be very, very, very careful that what is your starting point for calculating the taxable profit. What is it? Is it the turnover, or is it my net profit, or is it my profit after appropriation of item, so that you can exclude and include the things accordingly. So minus expenses which are allowed. Similarly, the thing goes for income. Now in this net profit, if I've included any income which is not taxable under this head, which is not taxable under this head, meaning thereby students I see people do not add back dividends. Dividends are not taxable under this head. They goes into other sources or interest as a matter of fact. Okay, so income not taxable under PGBP will be reduced, not add, will be reduced. And at the same time, income which should be charged to PGBP but have not been charged or added will be added back. Simple. This is how you do. So you have to be very careful of any adjustment which comes. You have to read all the adjustments, whether these adjustments have been given an impact in my P&L account or they have not given the impact in the P&L account. See, no rule book will give you one simple performer. The performer is just able to think that what is included, what is not included, and what has to be included or not has to be included. Clear? Now this, if I go as per section 29, section 29 simply says you have to take all your admissible deductions which are there under section 30 to 37. Under section 30 to 37, all admissible deductions means these are what are allowed. These are the expenses which are allowed. Then inadmissible deductions are under section 40 clause A and 40 clause B. Then your certain 40A subsection 2 subsection 3, which are the expenses of payments which are not deductible on certain circumstances. 41 is a deemed income section, deemed income of PGBPs, or which are said profit chargeable to tax. And then there are other provisions. Okay? So this is how we'll be going forward. Anyone has any doubt up till now? So my teaching is a profession. But if you're running a coaching center, you mean that it will again come into profession only. Sumit, I'll come to all the sections of 43, all the explanations of section 43, subsection 1. Do not worry at all. Okay, anything up till now? So now we move on to our first deduction, very simple deduction. How will you remember this deduction section? See, all the sections, deduction sections begins with section 30. Section 30, first of all thing, I told you take yourself as a business. Now for running a business, what is the first thing you require? A place, right? So this section relates to deductions in relation to buildings. but only rent, rates, taxes, repairs, and insurance. Okay, rent, rate, taxes, repairs, and insurance. Now, first, let's discuss rent. Now, these are deductions. So, any rent in relation to the building, any rent which is paid in relation to the building by the tenant, obviously, would be allowed as deduction. Would be allowed as deduction. But at the same time, if owner is, I am the owner. I am the owner, and I see Mr. X is running a shop. He's running it on. He's a tenant, and he's getting the deduction of rent. I am running my shop in a place which is owned by me. Let me just take a notional rent as a deduction. So notional rent deduction is not allowed. So for the owner, I'm the owner. I'm running my shop in the building I own. So I will not take a notional rent as deduction, but obviously actual rent paid would be allowed as deduction. Now coming to rates and taxes. What do you mean by rates and taxes? Municipal taxes, all these rates, or in foreign country if you're doing a business, cess there, or any taxes there, that are also allowed both to the tenant and the owner. Repairs which are in the nature of revenue, as in no capital repairs are allowed. No capital repairs, but otherwise repairs are definitely allowed for as a deduction in relation to building. So students, why do we need to remember the section? Because whenever repairs come, you will write repairs as per section 30 for building. Okay. Then your insurance premium which you pay for the building structure would be allowed. Any doubt up till now? No. Next we come to Section 31. Section 31, now as soon as you set up a structure, then what you will do if you have to run a business, you will take plant and machinery and furniture, right? So now Section 31 allows for repairs and insurance, insurance of plant and machinery. Now again, see students, all of these, whether it's section 30, 31 or coming sections, all these deductions will be allowed purely if they are in relation to your business. Let me elaborate. If I am running a building and that building, in that building I conduct a repair, but in that building I have my residential accommodation also and I have my office work also. So I will get proportionate deduction for that repair. I will get the proportionate deduction for that repair. Only which is exclusively used for the purpose of business would be allowed, and if it is not exclusively used, then proportionately would be allowed. Okay. Now for the repairs and insurance. Repairs of plant and machinery again allowed under section 31. No capital repairs allowed. Insurances again are allowed. Repairs, only current repairs. Areas of repairs would go in my section 37. Now students, if you interestingly note here, the rent of plant and machinery and furniture is not covered under section 31. So will you take deduction under section 31? No. There is a residuary section which is section 37, which covers all types of expenses which do not have a particular head, So I will take rent of plant and machinery in my 37, not in my section 31. But yes, rent of building is included in my section 30. Any doubt? Sumit, what do you mean by not to do something is also taxable under PGBP? Okay, so Gomati asked, ma'am, what is allowed and what is disallowed? Okay, Gomati, see, when I say an expenditure is allowed, it means that I will get a deduction for it. And when I say an expenditure is not allowed, that means my profit will not be reduced. And just in case in the profit which I have picked up, it is already reduced, I will add it back. I will add it back. And if it is not reduced, no effect is there and it is disallowed, I will not make any impact of it. Clear? Okay. Now we move ahead towards depreciation. Now, what do we mean by depreciation? The wear and tear is called depreciation. Wear and tear of our assets are called the wear and tear of the assets are called depreciation. Now, depreciation under income tax is totally different as a depreciation. The block is different as per your income tax. You have to prepare a separate depreciation chart for your income tax, not the Companies Act will go. Now, first of all, this depreciation is allowed only to the owner of the asset, only to the owner of the asset. This depreciation is allowed only to the owner of the asset. Now, by owner, I mean I can be a co-owner. So if I'm a co-owner, then if I'm I have half owned the share, so half part of it would be allowed as depreciation. Again, provided the depreciation which is being claimed on the asset is used for the purpose of business and profession. If it is not used for business and profession, then I will not get the deduction of depreciation. If it is used for business and profession wholly, then whole deduction. If it is used partially, then proportionate deduction. Clear? Then another thing is depreciation is mandatory to claim. What is mandatory? See, let me give an example if you can relate for section 44AD. Now under section 44AD, you do not have to clear, you just take the direct profit. But again, at the same time, it says that prepare your WDV chart so that you are mandatory claiming the depreciation, that in the year when you do not take 44AD, in the year when you do not give your income as per the presumptive basis, you have the actual written down value of the asset, not the actual cost of the asset. So meaning thereby you have to mandatory calculate the depreciation every year. Next, in income tax, you get depreciation as per the block of the asset concept. You get depreciation as per the block of the asset concept. Now, what is this block of the asset concept? The block is, you have majorly 4 categories: building, then you have plant and machinery, furniture and fittings, and then there is intangible assets. And then in building, you have different class of assets which have different rates. Plant and machinery have different class. Your furniture and fittings, then your intangible assets. The block would be any assets which have same rate and same nature, same rate and same nature. So if suppose, I'm just giving a hypothetical example, if building has something which is charged, or say plant and machinery has something which is charged at 15%, and similarly on the other hand, building there is some other asset which is charged at 15%, can I make this as a block? The answer is no, because even if the rate is same, but the nature of the asset is different. So same nature and same rate. Another example, if I have, say, for example, plant and machinery, I have one asset which would be charged at the rate of depreciation of 40%, another asset which would be charged at the rate of 15%, another asset which would be charged at 45%. So how many blocks will come? 1, no, 2, 3. 3 different blocks of asset would be created. Why? Because even if the nature is same, the rates are different. Now on the building thing, again, building should be my capital asset, which is used for business. Plant and machinery may specifically, tea and bushes are excluded, livestock is excluded, furniture and fittings are also excluded. Furniture and fittings will go in a separate head. Furniture and fittings will go in a separate head. Land pay, you do not charge depreciation. Livestock, I told you, will not come into this. Clear? Any doubts? Okay, so to your questions, capital repairs are something which increase the life or the capacity, or in case of plant and machinery, capacity to produce more for the assets. So suppose in for a building, if altogether I am just doing your normal whitewashing and normal repairs of whatever the cracks are there is the current repair, but when I'm altogether making another floor out of it, it is the capital repairs, or you can say construction, right? Owner, good question, Sumit. Beneficial owner, registered owner, always the beneficial owner. Ma'am, why it's mandatory to claim depreciation, Neha? See, I gave an example of 44 AD. What happens, students, is mandatory is so that one, your profits are not hypothetically increased for the purpose of business. And you will say, why, ma'am, why people show more of profit? Sometimes they need to claim their losses, they show more profits. Another example is when you are going to take presumptive income, you will take correct direct profit of 8% or 6%, as the case may be. Now, after 6 years, when you stop claiming your presumptive income, listen carefully. After 6 years, when you stop claiming your presumptive income, what will happen is your assets you will take at actual cost, and then you will apply the depreciation. But in real sense, your assets are actually used, correct? So that's why it said that you have to mandatory take the depreciation every year, calculate the depreciation every year, prepare your depreciation chart. Abhi, for the usage thing, Sumit, I'm coming, just very next thing is that only. So I was telling you it should be used for the purpose of business and profession. Now, interestingly, students, in your PGBP, there is one condition to start getting the depreciation. Obviously, it should be used for the purpose of business and profession, but again, it should be, the depreciation will begin from the year when it is actually used for business and profession. See, I acquired the asset, but I have not put to use. I had acquired the asset in previous year 16-17, but till this previous year 2021, I have not put to use, so I cannot claim the depreciation. The depreciation will begin from the year when I actually put to use, number one. Number two, if the asset is acquired, please listen carefully, if the asset is acquired and put to use in that year for less than 180 days, for less than 180 days. I said asset is acquired and put to use in that year for 180 days. I acquired it in the month of April, but I put to use it only in December. So less than 180 days, it will be used for this year. It would be used for less than 180 days, obviously, till the end of the year. So my depreciation, I would be allowed only at 50% of the rate specified. I'm coming to the rate, but it would be allowed at 50% of the rate. So if the rate is 10%, I would be allowed only 5%. But this is only in the year when I put to use, not in subsequent year. Not in subsequent year. Also, one thing, students, you have to take care at your stages that this 180 days wala condition is when you acquire it in the same year and put to use in the same year for less than 180 days. But if I acquire an asset in previous year 18-19, put to use it in previous year, say 2021, on 31st December 2020. Suppose, okay, will I get full depreciation or will I get half depreciation? Will I get full? I will get depreciation at full rate because the condition of 50% is in the year when it is acquired and put to use. If it is acquired in the preceding years and put to use in the current year, even less than 180 days, I will get full rate as full rate of depreciation as deduction. Any doubts in this point specifically? I'm coming to the rate part, don't worry. Now, many times the question is asked, ma'am, put to use and kept ready for use. How can you differentiate it? See, whenever an asset is acquired, there's one stage of acquisition, then there's one stage of installation, and then there's another stage of putting to use. Okay, so when an asset is acquired, and it is kept put ready to use, then also you will start getting depreciation. See, always an asset cannot be in a status of using. For example, fire extinguisher. What do you mean by put to use a fire extinguisher? That it is installed in a place where at the time of emergency I can use it, correct? So similarly, this comes as kept ready to use, and hence from the date fire extinguisher is kept ready to use, it is deemed as put to use, and I will get the depreciation for that. So passive uses are also covered. Anjali, don't worry. Presumptive income definitely by some classes you will definitely get to know. Savita, which point? Because I get the query a bit later, so please tell which point. Next, we come to your rates and method of depreciation. Because rates, so I told you half year and put to use 180 days. For you, acquired and put to use means if it is acquired and put to use till 3rd October, it is said to be more than 180 days. 4th October or later, if it is put to use, it is less than 180 days. But still, again, make sure it is that. Okay. So now, first question which will pop up in your mind is, whether WDV or SLM, whether we have to calculate the depreciation at WDV or SLM. See, when the asset is acquired and put to use, obviously actual cost has to be taken, but how does it work? Please, everyone on the screen, in income tax, the block is formed as, if you have any asset which is opening, which is coming from the previous year, so you call this opening return value, then it is mandatory to show the acquisition. So assets acquired during the year, जिसमें you will write it, see how you will write asset acquired and put to use for more than 180 days, asset acquired and put to use for less than 180 days, and also as per income tax it is mandatory asset acquired and not put to use. Okay, after that you will reduce from this any sale or termination value which you have received for an asset or any slump sale which has happened. Whatever amount which come would be the written down value for charging depreciation. Okay. Then from this you will reduce your depreciation for the year and you will get the WDV, or the closing WDV or the opening WDV for the next year. In your case, 31st March 2021. Now, how will you charge depreciation? I told you block would be the same nature, same rate. Depreciation again, at the opening plus more than 180 days pay, you will charge the full rate. At less than 180 days pay, you will charge the half rate. Not put to use pay, you will charge no rate. If there is any sale which has happened from any of these, you will remove it and then you will charge the depreciation. So now back to the concept, whether WDV or SLM, 99.9% WDV. SLM is at option for the SSCs who are into your power distribution, power generation or power transmission. Okay, for them it is an option that whether they have to take SLM or not. Well, what will happen if they take SLM? How the things happens for them, this will deal afterwards. Okay, but if they have claimed the option of taking SLM, then every year they have to follow SLM. But for others, it is always WDV, and this is how it is always calculated. Now to the rate. So I told you, building, please listen carefully. Building mein there are three rates: 5%, 10%, and your 40%. 5%, 10%, and 40%. Now, 5% is if the building is a residential building. Now you will ask, ma'am, residential building, how is that possible? Because we are again and again saying that depreciation is allowed only for business and profession. See, residential building is, suppose I'm a huge company. For my employees, I have prepared these quarters to live. I prepared these quarters. So these quarters are my residential building. So, and these are used for business and profession, so 5%. Hotels are not covered here. 10% if any other building which is used for asset. 40% is for temporary structure. Or any water, any building which is used for water supply management or water treatment. Temporary structures. Okay. Now, one thing, students, many times people ask this, that owner only gets the depreciation, correct? Building the case may, suppose if you do any such repairs which is in the nature of revenue, you take it under section 30. But if it is in the nature of capital and you are the tenant, it's not a revenue nature expense, but it's a capital nature expense. Obviously you cannot claim the depreciation, but income tax says that you can claim the depreciation by capitalizing the expenditure. By capitalizing the expenditure, you can claim the depreciation as a tenant. Okay. Now for the expenditure which you have done on that building, only that part would be capitalized and you will claim the depreciation. Now for plant and machinery, the general rate is 15%. Now coming to motor vehicles. Motor vehicles may, please listen, there gets confusion. Again, General it is 15%. But if the motor vehicle is used for hire purchase, higher as in into the higher business, then the rate is 30%. Then the rate is 30%. Now you will ask, ma'am, why so much higher rate? Again, common sense. See, if it's my general motor which is used for the business purpose, normal wear and tear. But if my work is only itself is that this motor would be used as a taxi or would be hired or would be used and so purpose, obviously the wear and tear would be more than any general motor which is used for a business purpose. That's why a higher rate of 30%. Clear? But last year, what happened? To incentivize the auto sector, our finance minister said that if you purchase any asset being a motor vehicle between 23rd August 2019 to 31st and acquire and put to use it by 31st March 2020, instead of 15%, you will get 30%, and instead of 30%, you will get 45%. Instead of 15, you will get 30, and instead of 30, you will get 45% for the whole life of that motor vehicle. So again, so that people purchase more cars, and use it for the purpose of business. They basically increase the depreciation rate by 15%. Clear? Any doubts? Chalo. Then books also comes as my plant and machinery. Books also comes as my plant and machinery. But again, for this motor and vehicle, you have to be purchased within this much period and you have to put to use it within this much time. Then only you will get the deduction, and that will not be only for 1 year, it would be for the whole lifetime of that motor vehicle. Now books, aeroplanes, ships, computers, ships I'll come later, 40%. All of these, 40%. Your life-saving equipments, 40%. Your what else which you need to remember is for 15%, then there is oil wells, then there is your windmills which are acquired before 31st of March 2014, but otherwise the bill milk rate is 40%, because you will definitely have in question which are acquired after 1st of April 2014. Ships ke liye it is 20%. Speedboat ships 20%. Okay? This is for my plant and machinery part. Now for your furniture and fittings. Now comes our furniture and fitting. Furniture and fittings like electric sockets and all, flat 10%. And intangible assets, 25%. Any doubt? Now for the computer thing, computer is 40%. Computer parts like your printers, your scanners, your UPS, everything comes into 40%. But mobile phones comes into 15%. Your EPBX, which is like your caller IDs, which are their caller phones, which are there in offices, that comes in your 15%, not 40%. Clear? Anyone has any doubt? Livestock is not my asset. Ma'am, if you took machinery in current year, put to use in next year, then what will happen to depreciation for current year? So if you acquire a machinery in current year and you have not put to use, you will just show it in the block of asset. You will not charge any depreciation on it. Then in the current year, when you have put to use, you will start claiming depreciation. Then you will not see 180 days wala condition, because it is acquired in different year and put to use in different year. If an asset is sold on 31st March of the previous year, then depreciation is not chargeable on that. Yes. If the Anjali and others, please tell me if it is clear. If the asset is acquired and not put to use, you will just add it in the block of the asset, but you will not charge any depreciation. It's equivalent to having not charged the depreciation on it. Okay, but if you have acquired and put to use, we'll do the questions so that it get more clear. Then you will charge the depreciation. Basically, depreciation will start from the year when you have put to use. If in the year of acquisition it is put to use and it is used for less than 180 days, then 50% of the depreciation rates which we have discussed. Next year onwards, full rate would be given. Now, students, this is the advantage of 180 days. One is that even if you use the asset for the whole year, you just sell it on the last date, then also the depreciation on that particular part will not be allowed. If you use the asset even if you acquire the asset at the middle of the year and put to use at the end of the year, then at least 50% of the rate of depreciation is allowed. So only 180 days ka criteria is there. Otherwise, depreciation is not proportionated to the number of days. It is not proportionated. Oil wells 15%. What is the use of high depreciation rate as we, however, depreciate whole amount during its lifetime? See, obviously, computers again have less time or less lifetime than any plant and machinery which is used in factory. So that's why they have higher rates for the one which have lower shelf life, or higher rates for the one which obviously have the huge cost. So that's basically lower shelf life, you can say. Sumit, don't worry. I will not go until I complete depreciation left, right, all questions answered. Then only I will take. So I'll request to restrict the question till the time we have taken up. Okay, uske baad definitely if something is left, you can point it. Srinivasa says, see again, if you are running a multiple coaching center, we're deploying, then you can take it as a business. But otherwise, if I myself is running a coaching center, I'll take it as a profession. Again, the level and scalability matters. But in both the cases, it will come in the same head. So let me just show you one simple sa case, okay? Then I'll come to your, okay. One of the question to analyze. Tell me, I told you ownership wala point. Tell me, in case of that, who will get the rent when it is a hire purchase agreement, or if it's a lessee lesser agreement? Who will get the depreciation and who will not get the depreciation? Who will get the depreciation? Who will not get the depreciation? Come on. Correct. See, basically again you have to see just one thing. If from the beginning of the hire purchase or the lease agreement, it is clear that the asset will go to the other party who is making the payment, which is lessee in the case, then the arrangement for income tax would be seen as just an arrangement of an asset purchased on installment, and the lessee will claim the deduction. But otherwise, in general, the person who lets the lessor will claim the depreciation, and the lessee will claim the expense of the rentals or the hire purchase payments. Okay, so again, whether it's a lesser lessee agreement, operating financial lease, or hire purchase, you just have to see that ultimately who is getting the right of the assets, who is getting the right of the asset. If the lessor is getting the rights, then or the lessee is getting the rights. If the lessee is getting the rights, ultimately after all the payments, then it would be taken out as a purchase made on installments, and lessee will get the depreciation ka benefit. He will not get the installments ka benefit then, okay? But otherwise, the lessor will claim the depreciation, and the lessee will claim the lease rentals which are paid during the year in the income tax. Okay? Both the things will not be claimed. Good. Now let me do an example for you. On this screen, I hope you can see. Yes. Now here again, I have for you an example. Just focus on this. I have opening written down value of 15 lakhs. I have made additions during the year for more than 180 days, for less than 180 days, and I have disposed of 11 lakhs from the old machinery part, and this is a plant and machinery ka question. Okay? So now WDV at the end of year on which the depreciation would be allowable would be opening plus additions less any disposal, 26 lakhs. Now how will I charge my depreciation? 15 plus 10 minus 11 pay I will charge 15%. 12 lakhs pay I will charge 7.5%. And then I will get this depreciation as 3 lakhs, and the WDV which will be carried forwarded next year would be 23 lakhs. 26 minus 3 lakhs, 23. Any doubts? Any doubts till now? Hope clear that how the depreciation is calculated. Okay, now we proceed to your next concept, which is called additional depreciation. How will block cease to exist? I will come to each and every question step by step. Now we come to a point which is called additional depreciation. How do we calculate this additional depreciation? Now, first of all, additional depreciation is a concept strictly for plant and machinery. Strictly and strictly for plant and machinery. Secondly, this is only for the assessees who are into manufacturing. So anyone who is into trading will not get the additional depreciation. Obviously, they are entitled to the normal depreciation which we are talking about, but not the additional depreciation. Additional depreciation is only for the assessees who are into manufacturing and only on the plant and machinery, not on buildings, not on furniture and fittings, only on plant and machinery. Manufacturing or who are into the business of power generation, distribution, distribution or transmission. Okay. Next, here the rate is fixed 20%. fixed 20%. Like plant and machinery may you have a rate of 15, 40, 20 and so on, but here you have a fixed rate of 15, fixed rate of 20%. Even if your plant and machinery is charged at 15%, additional depreciation would be allowed at 20%. If your plant and machinery is charged at 40%, then also additional depreciation would be allowed at 20%. Now here 180 days wala concept again come into picture. First thing before I go, additional depreciation is allowed only in the year when it is put to use, not in subsequent years. So this is a one-time benefit which is allowed to, again, to encourage manufacturing. This is a one-time benefit which is allowed in the year when it is put to use at the rate of 20% only on plant and machinery by a manufacturing assessee or a power generation assessee. Now, when you will ask, ma'am, if it is 180 days, if the asset is put to use for less than 180 days, what will happen? Then in the previous year, suppose we are talking about previous year 2021, I have an asset which is put to use for less than 180 days. Now, what will happen? One, normal depreciation would be charged at 15%. Two, additional depreciation would be charged at 10%, which is 20%, 50% of your 20%. Okay? But at the same time, in the very next year, the remaining 10% would be claimed. The remaining 10% would be claimed. At your level, question will not come that additional depreciation has to be claimed this year. Question will come like this, that additional depreciation was claimed last year. Now you have to be very vigilant enough to put and claim the depreciation which is left of that 10% this year. Now this 10% again, this 20% is allowed in the year when it is put to use and 20% of the cost. Okay, not the WDV. So this 10% again would be allowed of the cost, and the next year also the same 10% of the cost would be allowed, not of the WDV. So in the example, if I have to calculate additional depreciation would not be calculated at the opening WDV. First of all, it would be calculated on the additions only. On this 10 lakh, I will calculate 20%. On this 12 lakh, I will calculate 10%, which would be your 1,20,000. Again, next year, 1,20,000 would be claimed out of the value which is taken carry forwarded next year. I will not do 10% of the written down value. Clear? So you have to be very, very, very attentive that if in a question it is given in the previous year the asset was put to use, please put this as a red flag that I have to claim the additional depreciation this year at 10%. Okay. But having said that, you do not get it on all plant and machinery because this is for encouraging manufacturing. So you only get additional depreciation on the plant and machinery which is installed in factory premises basically. That means you will not get, if any plant and machinery is installed in offices or in any residential accommodation or in any guest house, you will not get the deduction for it. Only factory premises are allowed. Secondly, no second-hand machinery, whether used in or outside India. No second-hand machinery, whether used in or outside India. It should not be a second-hand machinery to take additional depreciation. Definitely on other normal depreciation which would be allowed, but this is only for additional depreciation. Then no transport or road vehicle. So on motor cars and all, you will not get the depreciation. Sorry. Then your last, any plant and machinery which is allowed as 100% as deduction, us pe you will not get the additional depreciation. 100% deduction you will see under section 35 and 35 AD, you get 100% deduction of capital plant and machinery. Us pe you will not get the additional depreciation. So these are the things which you need to take care of. Next is the rate of 35%. Now, to promote manufacturing, additional depreciation came, but to promote manufacturing in notified backward areas, of, there are only 4 states, and that too backward areas of these states, which are your Andhra Pradesh, Telangana, Bihar, and West Bengal. इनके notified backward areas only पे if you set up a manufacturing unit, वहां का plant and machinery पे you will get additional depreciation. Instead of 20%, you will get additional depreciation at the rate of 35%. What did I say? Additional depreciation for a notified backward area manufacturing unit, their plant and machinery would be charged instead of 20%, it would be charged at 35%. Now, but interestingly, students, this was only when you start up a manufacturing unit and acquire and install your assets between 1st April 2015 to 31st March 2020. So now you will say, ma'am, then why are you teaching us that? Because if we for us previous year 2021 matters, right? Then why are we learning this? Simple concept, students. If some asset is acquired in the previous year 1920 and it was put to use for less than 180 days in a notified backward area, so you should know that you have to charge, instead of 10%, you have to charge the depreciation at 17.5% this year. Additional depreciation. This is again for only additional depreciation. Instead of 20%, the depreciation rate is 35% for the manufacturing units which are there in the notified backward areas of Andhra Pradesh, Telangana, Bihar, West Bengal. Then the asset should be acquired and installed between April 15 to 31st March 2020. But since 31st March 2020 has already gone, for you what matters is that any asset which is acquired in the previous year 1920 and was put to use for less than 180 days, for that you will give 17.5% balance additional depreciation. Clear? Now I'll do one question, then I will come to your doubts. If then also there is any doubt, you can give, you can write them down. One second. Okay. Why is this hanging? Sorry, students, one second. Huh? Okay. On your screen, students, this is a question given to you. Mr. X, a proprietor engaged in manufacturing business, furnishes the following particulars. Opening WDV of plant and machinery as on 1st April 2020, 30 lakhs rupees. New plant and machinery purchased and put to use on 8th June, 20 lakhs. New plant and machinery acquired and put to use on 15th December, 8 lakhs. Computer acquired and installed in the office premises, 2nd January 2021, 3 lakhs. You have to calculate the amount of depreciation and additional depreciation. See, students, be it PGBP, be it capital gain, be it anything. Whatever is the question which has asked, only that part, that much calculation should go in your question. All other part of it should be your working notes. Please, if you want to score good marks, if you want to score exemptions, presentation becomes very important. More than presentation, your assumptions and working notes become very important. You cannot just assume that this much should be known by the preparer or the teacher who's checking. Okay, so one tip, always take care. Depreciation amount is asked, so I will only show the depreciation amount. I will not show the WDV amount. I will not show any other thing. Okay, so now let's calculate the depreciation. 30 lakhs plus 20 lakhs pay. I will calculate, since it's a manufacturing business, it's a plant and machinery, I will calculate 15%. 50 lakh pay 15%, 7.5 lakhs. Then on 8 lakhs, I will calculate 7.5%, 60,000. Then on this 3 lakhs, since it's a computer, I will calculate 40%. This is my normal depreciation. But it is used for less than 180 days. I will calculate 20%, which will come to 60,000. This is my normal depreciation for my assets. Now for additional depreciation. Additional depreciation is only allowed in plant and machinery, but computer which is installed in office premises is not my plant and machinery for additional depreciation. If this computer would have been installed in a factory, it would be my plant and machinery for additional depreciation. But since this is installed in office premises, this is not my plant and machinery for additional depreciation. So additional depreciation would be only on these two additions. 20 lakhs pay, again 20%, 4 lakhs. 8 lakhs pay, 10%, 80,000, and the remaining 80,000 would be claimed next year. Anyone has any doubt? This is the solution. Take a look at it. Now I will take your doubt and correspondingly I will give you one more question to solve so that you people have confidence as to how these things are solved. Okay, so the first one to give the correct answer will get a shout out. Okay. Okay, so good question about what about printing. Additional depreciation is available to them. See, there is this judgment which says that printing or printing and publishing results to manufacturing of a new thing. So that's why additional depreciation is also available to them. Okay, I see no doubt. Then let's give you a question to solve. Okay, so on your screen there is another question about about a newly qualified chartered accountant, Mr. Dhawal, commencing practice and has acquired the following assets in this office during the financial year 2021 at the cost shown against each item. You have to calculate the depreciation that can be claimed for his professional income for assessment year 21-22. Assume all assets are purchased by account page check. I'll give you the understanding of what account page check is all about, but you have to be the first one to tell me that what is the total depreciation including furniture, fittings, plant and machinery, everything, and how many blocks will come. First of all, see how many blocks you will make. And even if you will calculate the final answer as depreciation correct, but if your presentation of blocks will be wrong, you will not get the full marks. So on your screen, the question is, please start practicing and give me the answer. Okay, let's see how many of you have given the correct answer. No. Okay. The first one is Sumit Agarwal. He has given the correct answer. 64,500 is the correct answer. There are only two blocks. One is of furniture. Next is of plant. And in plant of 40%. Very good. Others, what happened? Why there is an error? See. What is the mistake done? What was the mistake done students? Okay, now everyone knows. Is it clear? No, Sumit Jain. Yes, Gomati, in all the case put to use, I'm telling you from put to use the depreciation will come, okay? And allowed. Acquisition is not the criteria for giving the depreciation. Anyone has doubts? Sure. Now, coming to the power generation units. Now, power generation के students, what happens is they have an option to take it as WDV or SLM. If they take it as WDV, that is fine. But if they follow SLM, then every year they will just reduce the depreciation, which is at the rate of their actual cost, correct? Which is at the rate of their actual cost, which you call as Rule 5(1) MA. Okay. Now, here disposal become very interesting. That is when they dispose of an asset. When they dispose of an asset, what happens? Now, when they dispose of an asset, disposal become very interesting with a concept called terminal depreciation or balancing charge. Terminal depreciation or balancing charge. Now, I had an asset of cost 100 lakhs. Every year on SLM, the written down value came as 70 lakhs, okay? And I have sold it for 60 lakhs. First case. Now, whenever this such things happen that I have an asset which I have sold at a price lower than my written down value, in case of power generating units, then what will happen? The difference of the WDV and the sale price or the terminal price is charged to P&L account, which is your 10 lakhs, as terminal depreciation. It is charged to P&L account as terminal depreciation, but it will be charged only if the asset is actually written off in the books. It will be charged only when the asset is actually written off books. This is called terminal depreciation. Why? Because at the time of termination of assets, we did not receive to the written down value of the asset. So the amount which is in deficiency, we write it off, and hence, and it is at the time of termination. That's why it is called terminal depreciation. Okay. Now the other case. What if instead 100 in WDV 70, but instead of 70, you sold your asset at 80. You sold your asset at 80 or say 85. Then in that case, what will happen? It is a pure case of income, because more than the current value, which is a written down value, you are selling your asset at the higher price, which is 85. So the additional amount would be charged as income as my balancing charge under section 41. But this is again, students, purely for power generation or power distribution SSC. Okay, so this 15 would be charged as balancing charge as an income. This is a charge which is done to balance the depreciation amount. That's why a balancing charge. Clear? Now, what if another example? Cost is 100. WDV is 70. But the sale price now is 125. Yes, I'm selling it over and above the cost. I'm selling it over and above the cost. Now, please do not say 55 would be my balancing charge, because balancing charge goes to my P&L account. Please listen, no one will tell you the concept. Balancing charge goes to my P&L account. P&L account में I can only take it, P&L account में I can only take it to the amount I have charged in the P&L. If I have not charged any amount in the P&L, I will not take the income of that on reversal into the P&L. Hence, meaning thereby, I would have charged only to the extent of 30 as depreciation in my P&L throughout the years. So now you will say, ma'am, there is a gain of 55. I will say the income, there is an income of 55. I will say, yes, there is an income of 55, but only to the extent of 30 would go in my PGBP income as balancing charge. I will repeat, don't worry. The remaining 25 would be my capital gain income and will go under the head capital gain. What did I say? The gain, you are comparing it from 70 to 125. But I say no. Take it as the gain which is of 55 is actually would be distributed as to the extent of the cost would be charged under balancing charge, and the remaining, which is over and above the cost which you have received, would go in your capital gain income. Now think from a business logic. Why so? I am telling you, you are into your PGBP income. Okay? You are into your PGBP income. You have your PGBP income, and now you, over the year, you are charging depreciation. You charge the depreciation in the cost. Now the reversal, if you are making any gain, only to the extent of the cost should go in your P&L account. Now, if I have not charged anything out of my profit, which is the depreciation throughout the year, why the income should go over and above the cost in my P&L account? Only to the extent I am recovering my depreciation, that should go to the P&L account. If I am recovering over and above that, it is my capital gain. It is my capital gain. That is what has happened. Out of 55, only to the extent the depreciation was charged, that is being balanced by balancing charge under the head section, under section 41 in the PGBP head. The remaining 25 will go in my capital gain head. And please try understanding this concept, because this concept would be applied in many places when it comes to amortizations, your scientific research, everywhere this thing will come. So please try and understanding it, that why 25, why 30 is my business income and why 25 is my capital gain income. Again, I'm giving you the concept that 30 is my business income. Why? Because only to the extent of 30 was what was charged in the P&L account over the years, obviously, but and over and above the cost will go in my income capital gain head. Sorry, my bad. Sharing, sorry, was paused. Sorry. Take a time to absorb this. I'll repeat it again very quickly. For power generation, SLM, if they're opting SLM, and if the black handwriting, if the sale price is less than WDV, then the balance amount will go as my terminal depreciation. The balance amount will go as my terminal depreciation. Reason being that this is the depreciation which we are writing off at the time we are terminating the asset. Okay. But if my sale, the pink one, if my sale price is more than WDV, then the amount which is more than WDV till the obviously till the cost. So in this case, the additional amount which I've received would go as my income in under section 41 with the name of balancing charge. Why it is called balancing charge? This is the amount which balances my charge, which is taken out from the P&L throughout the years, which is in the name of depreciation. So 15 amount would go in my balancing charge. Now, if I'm selling my asset over and above the cost, not over and above the WDV, but over and above the cost itself, then what will happen? The total gain would be divided into two parts: my business income, my capital gain income. Business income would be to the extent of the cost, and over and above the cost will go to the capital gain. To the extent of cost would go into PGBP income as balancing charge, and over and above the cost, which is 25, would go as my capital gain income. The reason is that in my business income, I can only take the income to the extent of expenses which I claimed, which is the depreciation which I claimed during the previous proceedings year. Any doubt now? Shalini, Savita, Sumit, everyone now, is it clear? I'm sorry for the board thing. Anything you want to revise in this first? So now for the terminal depreciation, see this example. Mahapower Limited purchased an asset on 20th of July 2016, the actual cost of which was 100 lakhs. Mahapower claimed depreciation at 5% on the actual cost. 5% on the actual cost means they are using SLM of the asset. WDV of the asset as on 1st April 2020 is 80 lakhs. On 15th May 2020, Mahapower sold the asset for 55 lakhs. Deduction allowed as terminal depreciation would be sale price of 80 minus WDV 55, which would be 25 lakh, provided the same is written off in the books. Clear? Yes or no? Now for the balancing charge. One second. One second. See, understanding this concept take time. Don't not worry. But once you will understand, it's very, very simple. Now for the balancing charge. Again, on the same things, instead of 80 lakhs, the WDV now is instead of 55 lakhs, the WDV now is 90 lakhs. WDV is 80 lakhs, but the sale price is 90 lakhs. WDV is 80, but the sale price is 90 lakhs. The balancing charge would be 10 lakhs, which would be taxable as my income under section 41, subsection 2. Clear? And for the remaining understanding, you can see these three cases. Terminal depreciation ka black, balancing charge ka pink and green. If it is clear, not clear, please give your nods. Kunal, don't worry, the material would be available by next week or so. Don't worry. Shalini. Okay. So again, for the last time, please understand. No, Rohita, see, even if it is simple thing, even if the asset is sold at the end of the year, or if the asset is sold at the beginning of the year, the basic thing which you first of all always do is before charging depreciation is always removing the sale and termination in normal circumstances also, correct? In normal things also you do. So in here also, when I'm talking about your balancing charge and terminal depreciation, then also you have to consider the same thing. I will also come onto the block of assets seizing and that also, but before that you please try understanding this. Again, we'll take a simple example. Okay. Now students, three different scenarios. Cost is 200, WDV is 100, sale price is 80. Now this is a case of a powered undertaking, please. In the first case, there would be terminal depreciation of 20 lakhs. And this would be charged to my P&L account. That means this would be a deduction in my P&L account of 20 lakhs. Why this is called terminal depreciation? Now, because the asset is sold, we are still have to write off the difference amount. That writing off is known as terminal depreciation. WDV 100, sale price 120. Or let's make sale price as better clarity के लिए 130. ठीक है? So balancing charge would come into picture of 30 lakhs because over and above I've received my WDV. This 30 lakhs would be charged to my P&L account under section 40. Would be charged as an income under section 41. ठीक है? Now sale price is 210. So up till 100, which is the difference of my cost and WDV, will go as balancing charge, and the 10 amount will go as my capital gain income. Anything over and above the cost is not related to my business. That is my capital gain part. Up till the cost, I will take it as an income. Why? Because from the cost only I've taken the depreciation. So now if I'm having the gain, usko I will add back as income. Simple. Clear? Yes or no? Chalo, great. Gumati, Sumit, everyone now clear? Now on this note, I will take a break. After break, I will tell you sale and purchase of normal assets. Okay? Not the balancing, not of the power undertaking one, normal SSEs. And we'll start up with your then we'll do what if succession happens, reorganization happens, and then I will come to the actual cost concept. Okay? Very important parts coming after the class. Take a break and let's meet by 7:40, 41. Thank you. Jessa? Yes. right? Okay. So welcome back, students. I hope your doubt in relation to terminal depreciation is clear now. Before we proceed, Vese section 50 talks about your capital gains on depreciable assets. But I think at this point also it should be taken up to a bit extent. So let's take that first. Now my section 50 students talk about capital gain in relation to depreciable assets. Capital gain in relation to my depreciable assets. इसमें भी it is very simple. First is your let's just take like this. Okay. You sell your whole block of asset or you sell the part block or a single asset of the asset. Okay. So either you're selling the whole block of the asset or you're selling the part of the asset. First, we'll take whole block. Whole block means whatever was there in that block, full ka full you have sold on that block. So two things will happen. Here, a balancing charge को थोड़ा सा side पे रखो, ठीक है? That is only for power generation units into SLM, ठीक है? Now we are talking about normal assets, normal entities, normal SICs who have depreciable assets. Any depreciable assets, be it plant and machinery, anything. Okay, so whole block of the assets go, you are selling all the assets. So two things can happen. Either my sale price can be more than my WDV or my sale price will be less than WDV. If my sale price is more than WDV, suppose WDV was 100, sale price was 120. Then whatever different comes will go into capital gain as short-term capital gain. Okay? And if my whole part of asset is transferred, whole block of asset is transferred and sale price is less than WDV, say 70 and WDV is 100. So whatever remaining is, it is a capital loss and it will go as short-term capital loss. It will go as my short-term capital loss. Okay? Now on the block of the assets. Before I do part of the block of the asset, if you remember, all of you remember, what did I tell you? That first you calculate opening, then you make additions, right? And then in that additions, you reduce the sale price. And then on this value, you calculate the depreciation, correct? Keep this in mind. And now let's see part of the block of the asset is sold. My opening plus this WDV say comes as 100, additions for WDV. My sale price is 80. Sale price is 80. 100 is my WDV. So very simple. On the remaining 20, I will charge the depreciation. Opening plus addition is 100 and this is 80. So on the remaining 20, you charge the depreciation, right? That only I have done. Part of the block may. Now, if opposite happens, opposite as in another situation happens, that my sale price is 140, my WDV including addition is 100. Now what will happen? Either फिर से let's put it 100 and this is now 140. What will I do now? So this 40 would come as my short-term capital gain and there would be no depreciation. And there would be no depreciation. Ma'am, yes, the assets are there. Yes, the assets are there. But now there would be no depreciation charged. Clear? So this what happens when there is the sale of depreciable asset. Either you will sell the whole block or you will sell the part block. Part block may, if the sale price is less than my WDV plus additions, then obviously on the remaining amount I will charge depreciation. But if the sale price is altogether my above my WDV and additions, whatever comes is my short-term capital gain. This is section 50, which is there in your capital gain. In your PGBP chapter, you will not find this, but it was important to touch here. Why it is always STCG and STCL? Good question, Sumit. Because you are calculating the gains from the written down value, which is nothing but your current value. So that's why it's always short term. Cost 220 WD. See here, when I talk about normal depreciable assets, we do not take a comparison with the cost. We do it normally. Terminal depreciation and balancing charge comes when SLM is applied, and that when only power taking sectors. Okay. Any other doubt? When whole block is sold, block cease to exist? Yes, block cease to exist. Simple. And next we move to the concept where sorry, my system gets hanged. Yes. Next, we move to the concept where I talk about that there happens some succession, either the firm is getting converted or amalgamation happens or demerger happens. What will happen in these cases? How will the depreciation will charged in these cases? If LLP is converted into company, company is getting converted into LLPs, proprietorship is getting converted into companies, and so on. What will happen in these cases? Very simple. See, first you will calculate the depreciation as if nothing has happened. Close your eyes and calculate the depreciation as if nothing has happened. Similarly, add opening. Opening may add your additions. Additions may reduce any of the sale amount. Then take this amount, calculate the depreciation, come to the WDV. Now, this depreciation will then be proportionated. The depreciation will proportionated basis the number of days the assets is used by each one of them. Basis the number of days the asset is used by each one of them. Now, let's take an example. This is an example of your question only. There is a SCI Limited which has an asset. Opening WDV for them is on 1st April 2020 is 40 lakhs. Then on there was an addition on 1st November 2020 of 14.4 lakhs. 14.5. ठीक है? We're talking about plant and machinery ka block, okay? 15% wala. But then they get amalgamated into ICAI and Shirdi Limited on 1st January 2021. Now, what is the depreciation for ICAI and then ICAI and Shirdi? First of all, I will calculate the depreciation as if nothing has happened. So I will calculate my depreciation. 40 lakhs pe I will calculate 15%, which will be 6 lakhs. And 14.4 pe I will calculate 7.5%, yes. Which would be 108,000. Okay. Now 7,08,000 is my depreciation, correct? Now you will not proportionate 7,08,000. First of all, the number of days the assets have been used by each one of them. Total 365 days. 40 lakhs वाला जो asset which is opening asset, 1st November को, sorry, 1st January को amalgamation happened. 1st January को amalgamation happened. So there is sign and there is sign and Shetty. I'm doing it so that you don't have to worry about how this thing happens. Now, this opening wala asset, 365 days in total. From 1st November till 31st March would be for Sai and Shiddi, which would be your 90 days. January के 31, February के 28 and March के 31. ठीक है, 90 days and Sai के पास it comes for 275, right? 275 days. So this 6 lakhs को I will proportionate 6 into 275 by 365 and here 6 lakhs 275 by 365. And this 1,08,000, this came only from 1st November 2020. Only from 1st November 2020, which was only for 151 days in total. Okay? And out of this 151 days, 61 days were here, 90 days were here. So 1,08,000 into 61, 1,08,000 into 90. Again, please do not make an error of proportionating 7,08,000 full. No, you will proportionate 6 lakh as per the number of days, 1,08,000 as per the number of days, because here proportionating happens as per the number of days used by each one of them. Any doubts? Yes, no, all okay? Chalo, great. Interesting. So now Sumit says, ma'am, what if Shiddi Limited acquired an asset? That would be a different story. For that, only Shiddi will get the depreciation. We are talking about the predecessor part. For the predecessor, first of all, you will calculate the depreciation as if nothing has happened, and then you will proportionate it as per the number of days. Kunal says, ma'am, how it could be short-term capital gain if you have purchased an asset many years back and we did not make any purchase. That does not matter. The capital gain you are calculating, the gain part you are calculating is you are calculating from the current written down value, which is the value which is today. Written down value is what? The value which is now, which is relevant today after the depreciations, right? Chalo, great. Now we come, I'm again and again and again in saying that you have to calculate your this thing, your depreciation on the actual cost, or which basically the actual cost has to be added into the written down value into the block of the asset. Actual cost. But what is this actual cost? Now, students, this actual cost is defined in your section 43, subsection 1. Listening here becomes all the more important because this is relevant in your PGBP part also, and actual cost wala part in the capital gain also. So please listen. There are so many case scenarios which will be coming up. I request each one of your attention now back to the screen. Now, actual cost as per section 43 subsection 1 says few things. Let's just take first that. Now, in my actual cost, students, I will take the purchase price for what amount I have paid it. Now, one thing, purchase price, one thing everyone has to be clear that this asset for a value which is or anything should not be paid in other mode other than account pay check, account pay bank draft, electronic clearing system, or prescribed electronic modes, other for a value of more than 10,000. So if I purchase an asset of 5 lakhs, this means if 5,000 I paid it in cash, that is fine. But if I purchase an asset for 5 lakhs and I paid 2 lakhs in cash, so 2 lakhs will not be allowed to be capitalized, or 2 lakhs will not be allowed to be taken in my cost. So the concept is that you cannot pay more than 10,000 for the assets in cash to take it as your actual cost, or more than 10,000 for any mode other than account pay check, account pay bank draft, electronic clearing system, or prescribed electronic modes. When I say prescribed electronic modes, these are your BHIM, UPI, RTGS, NEFT, IMPS, all of these. Credit card, debit cards, all of these. Okay, so purchase price should not be more than 10,000 in cash or the modes other than the modes specified. Then on in this, what will I do? I will add my installation charges to come to the actual cost. Okay, simple accounting which we used to do. Correct? I will add my transportation charges. I will add my installation charges. Duties, GST or import duty. So if I am not getting the input credit, then I will capitalize them also. If I'm getting the input credit, I will not capitalize them. Then your interest on loan up to it is put to use will be capitalized. After it is put to use is my revenue expenditure. Simple. Again, 11th ka accounts has to be capitalized. Apart from that, it would be taken as revenue. Then any trial runs, you before finally putting the machinery for commercial productions in big plant and manufacturing, what happens is trial run happens. What happened? Trial run happens. So trial run, the cost is also capitalized. This is as per your ICDS also now. Trial run cost is also capitalized, and in that trial run, suppose you were making any samples, and from that samples you have earned any amount from the sale of that samples. Obviously, you will reduce as. Okay. Then think any grant and subsidy which is received would also be reduced. Obviously, you have not paid the amount for it, so that would also be reduced. So grant and subsidy will also be reduced. Whatever will come would be my actual cost. Clear? Yes or no? Simple. But there are so many scenarios which are taken up in the explanations. Few of them we have already taken as interest, trial run, installation charges, transportation charges, all of these. Rule 60D is altogether, Sumit, a different for your 40A3. That is not taken here. It is only a simple thing that you cannot purchase an asset to capitalize for a value of more than 10,000 in cash. Shiddi, what are you saying? What's asked this? Okay, Sumit, on the sorry. On the 1,08,000 wala asset, I will apply 151 as my denominator, not 365. Okay, because 151 ही it was full put to use, तो उसी को I will proportionate accordingly. Be very careful in this proportion. Okay, so this is clear, but again, it is not as common that everyone will go to market, put some expenditure on freight and trial runs, and then capitalize their assets. Sometimes people purchases or acquire assets or put the asset into business by various other modes, not only going to the market and getting it. So all those various modes may what would be my actual cost? In all those various mode, what would be my actual cost? Let's just see that. Now, these various modes have come into explanations in your section 43, subsection 1, which is my actual cost curve section. The first explanation is very simple. You can, for you to make yourself understandable, you can prepare a 2 tabular chart, 2 column chart in your notes, right situation, right actual cost. Okay, so now let's begin. If an asset which is used for scientific research, if an asset is used for scientific research and then it is brought to business. Now, when we do scientific research ka section, usme you will understand that what happens is, scientific research mein koi bhi any asset gets 100% deduction. That means now you have claimed 100% deduction of cost in your profits. Yes, 100% deduction. If it is used for scientific research, now you have brought it into normal business. Now you have brought it into normal business. Then what happens, students? Because already you have taken the deduction. So here for normal business, the cost of that asset will be nil. The cost of that asset would be nil. See, again, this is a asset which are used for scientific research. Now it's the full cost I've already claimed as deduction. Now this is my scientific research segment. Now I brought this asset into my normal business segment. Now I've already claimed 100% deduction. How now I have to add it in the block. I will add it in the block, but the value I will add it in the block would be nil because 100% cost has already taken a benefit of. Clear? Next explanation says, explanation 2. Inventory converted into capital asset and used for business and profession. Now, what is this, ma'am? Again, simple. Take yourself as a real estate business. Okay, I had already purchased, built so many buildings. Very bad drawing, right? Yeah, I have built so many buildings. Now, these buildings are my stock and trade. These buildings are my inventory because I'm into my real estate business. Now, one of this building I use as my office premise. My office building. This is my office building. I will set up my office structure here. I will call the parties here. Now, my inventory is getting converted into my capital asset for business purpose. My inventory is getting converted into my capital asset for business purpose. Yes. Yes. So now this building has to be added into block of asset. Correct? Now, at what value will I add this building? I will add this building at a value of fair market value on date of conversion. Whatever is the fair market value on the date of conversion would be my actual cost to be taken up in the block of asset. Will be my actual cost to be taken up in the block of assets. Clear? Up till now, clear that these are the various scenarios that instead of going to the market and purchasing it from someone, the asset comes into business through various routes. One was scientific research, another is this conversion of inventory into capital asset to be used for business purpose. Sumit, on 6 lakhs, I have done 365. Next explanation is my asset is acquired by way of gift or inheritance. Explanation 3. I hope you people are writing together. This is not explanation 2, this is explanation 1A. Explanation 3 talks about asset acquired by gift or inheritance. Now I am into a business. This building is given as a gift by my father, suppose. Now a building in which I run my office is given as a gift by my father. So what would be the cost which would be taken up in the block of asset? Would be the cost to the previous owner, minus depreciation which he would have allowed as if it was the only asset, minus depreciation that he has been taken up. So basically if he has taken that building 10 years back, so 10 years pehle ka cost minus depreciation for 10 years, coming to the today's value, this would be my cost to be added in the block of assets. Clear? Now, next is my second-hand assets. Now, second-hand assets is very common, right? People may not always purchase first-hand asset. They may purchase sometimes second-hand assets. Now, students, second-hand assets, mein what happens? Income taxes find many loopholes. That second-hand asset may people inflate the value of the asset unnecessarily, inflate the value of the asset so that they can claim the depreciation at a higher amount. Simple C value. I would have purchased a second-hand asset for suppose 1 lakh, but I went to my friend Mukesh. He was already having losses, so I said, "Sell me this asset at 5 lakhs. Your profit would be set off by your losses." So instead of 1 lakh, I have purchased this asset in books on paper for 5 lakhs, second-hand asset, and I'm claiming the depreciation instead of 10% ka 1,10,000, I'm claiming it 50,000. Okay, so these things can happen. Yes. So what income tax says that in case of second-hand asset, whatever value you take, you take. But if the AO feels that this is an inflated value, then whatever the AO will decide the value, that would be the value of your second-hand asset. That would be the value of your second-hand asset. Okay? This is when the AO will decide the value, but AO will obviously decide the value with the approval of the Joint Commissioner. And he will tell that why he has determined such value. Which explanation? See, rate of depreciation would be that depreciation rate only which is applicable for that particular asset. So with all these explanation clear, next is my reacquisition of asset. I am reacquiring the asset. Ma'am, what is the difference in second hand and reacquiring? I will explain that after a certain time. Okay. So now I'm reacquiring the asset. What is the case of reacquiring? Reacquisition of assets. This is my explanation 4. And then there is 4. Yes. Now, in case of reacquisition of assets, student, what happened? Very simple. I gave Mr. A, suppose Mr. A gave the asset to Mr. B. Then Mr. B gave it to Mr. C. Mr. C gave it to Mr. D. And Mr. DC again, Mr. A acquired. Now we have to determine the cost of asset for whom? We have to determine the actual cost for whom? Mr. A, when he has reacquired it. It was with him, then it went to various people, then he reacquired. It may be reacquired from Mr. B. The chain can be broken at any time. He is basically reacquiring the asset which was once his. Now, what will happen for that? Actual cost would be simple. The price which he paid to Mr. D for reacquiring, or the actual cost of the asset when he acquired it first minus the depreciation till the time he transferred. Ma'am, why so? Simple sa point hai. I am reacquiring the asset. Again, that could be an arrangement of taking the asset at an inflated value. So they say, suppose I paid Mr. D again 6-7 lakhs, but actually after cost minus depreciation was already coming to just 1 lakh. So the lower of which is lower of the price paid or the actual cost minus depreciation would be the actual cost on reacquisition to Mr. A. Would be the actual cost on reacquisition to Mr. A. Clear? Next is, this is again very interesting. Asset acquired and then given on lease. Now suppose, please listen carefully. Very important, this way people get confused. Now Mr. A purchased an asset from Mr. B. Mr. A purchased an asset from Mr. B. Mr. B was already using that asset. He purchased it from Mr. A purchased it from Mr. B. But then again, Mr. A gave that asset on lease to Mr. B. Mr. A again gave this asset on lease to Mr. B. Now this happens many times, students, again to claim depreciation, to claim lease rentals. Actual ownership is not transferred, only on paper it is transferred. So many times these arrangements happen. So Income Tax Act, what they did, they said, when such a scenario happened where you purchase the asset and then you lease it back again to the same person from whom you have purchased, in that scenario, the actual cost of the asset would be, first of all, ask yourself the question, for whom we are calculating the actual cost? We are calculating the actual cost for Mr. A, because Mr. B is a lessee now. Now Mr. B is the lessee. So who is the lessor? Mr. A is the lessor. For him, I have to calculate the actual cost. The actual cost would be the written down value of the asset when Mr. B transferred. So when this transfer happened, whatever was the written down value in the books of Mr. B, that would be the actual cost in the books of Mr. A. That would be the actual cost in the books of Mr. A. This is my explanation for A. Now, all of these cases are of second-hand assets, but whenever a specific scenario happens, this general scenario of second-hand will not be applicable. Okay? Whenever you have a specific case, then that specific case will override the general case. Again, I will say, generally second-hand asset, whatever cost you have purchased for, you will take it. But if AO thinks that is inflated, whatever cost he determines. Reacquisition of assets may, if you reacquire the asset, so whatever the price you pay on the reacquisition or the actual cost minus depreciation, actual cost to you when you first acquired it minus depreciation, whichever is lower. Next, when you purchase an asset and then you lease it back to the same person from whom you have purchased, the cost would be the written down value in the books of the other written down value in the books of the person from whom you have purchased. Any doubts? Absorb here a bit. For which year rate of depreciation is applicable? For which year rate of depreciation is applicable? Sumit, please elaborate your question. Again, students, if you will take this as theory, this would be very boring and you will lose interest. But if you will understand it, actually writing that this is a scenario and applying your own sense, that obviously this should be the cost, you will obviously come to this answer. Okay, next is my seventh part. Explanation 5. Building previously owned. Or I should write building previously property of the assessor. Now, in the first example, not the first, the second thing which we discussed was when your stock in trade was getting converted into the capital asset. Now, here is of business. Now, here is when your personal asset is getting converted into capital asset of business, and that too only building. That too only building. उस case में the actual cost for the block of the asset would be the actual cost for which you have purchased minus notional depreciation for all the years which was purchased by which it was with you. So now suppose there was a building which is my own where I used to live for 10 years. Now that building I'm vacating and I'm using it for office purpose. Now that building I'm vacating and using it for office purpose. So the actual cost which has to be capitalized in the books of accounts for income tax would be the cost for which I purchased 10 years back minus notional depreciation of 10%. That value would be the actual cost in my books of accounts. Clear? On the same lines, exactly same lines, there is your explanation 11. When you acquire an asset outside India, when you were a non-resident, and now you have brought that asset to India. You were actually living in Australia and you brought this plant and machinery to a machinery to count the currency. Okay, you were non-resident then. Obviously, you were non-resident then. Now you brought it to India and used it for your own business, that counting money machine. Okay, what would be the actual cost of that asset in your books of accounts? Totally same. Actual cost would be the cost for which you purchased minus the notional depreciation for all the years when it was with you. Okay, minus the notional depreciation for all the years when it was with you, assuming that this has been used from the first day itself for the business. Okay, exactly on the same lines. Sumit, if the asset is acquired 10 years back, then all the 10 years depreciation would be applied at what rate? For all so many years, it would be applied at 10% only, because obviously very rare the rates have been changed. Okay. Everyone getting the hold of it? I'm really going slow so that a momentum and an understanding could be created at the same time. Next other scenario, explanation 6. When an asset is transferred from an holding company to its 100% subsidiary company, or when 100% subsidiary to its holding company. An asset is transferred from an holding company to its 100 subsidiary company or vice versa, provided the transferring company is an Indian company. Now, what happens is when you transfer an asset, if I transfer an asset to X person, capital gain comes into picture, right? But if the transfer happens between these two entities, it is not a transfer. It is not regarded as transfer. It is not regarded as transfer, and it is not charged to tax. This you will see in your capital gain. So, what would be the actual cost for the company receiving it? What would be the actual cost for the company receiving it? So it would be same had the transfer not taken place. It would continue to be the same as the transfer has not taken place. Clear? Any doubts? I will ask questions in the next class. If you have any doubts, it's better ask. Where any capital asset is transferred by holding company to its wholly owned Indian subsidiary company, or a subsidiary company to its 100% holding company being an Indian company, then the transaction not being regarded as transfer of a capital asset. This I told you. The actual cost of transferred capital asset to the transferee company shall be taken to be the same as it would have been if the transfer company had continued to hold the capital asset for the purposes of its own business. It would be same. The actual cost would be same. Clear? Once. Next is amalgamation and demerger. Amalgamation and demerger case maybe it happens the same. Now the actual cost you have to calculate for amalgamation would be for the amalgamated company. Again, the actual cost would be the same had the original company continued to hold it. Then for the demerger case में two things happen. There is a resulting company and there is also the demerged company. Resulting company के लिए the cost would be the cost of the asset which has been transferred to him, but it will not succeed the WDV. And demerged company के लिए, that is the remaining company, would be the total cost minus the cost of the asset transferred to the resultant company would be the remaining actual cost. Or you can say the WDV. Clear? Up till now, anyone has any doubt, they can give a read. Students, by the time the new material does not come, it will take just a week more. Most of the cases are same. There's just a slight change in your 35% wala case because that is only 17.5% applicable for all of you. So otherwise, you can refer to the old material. I will tell if there's any changes which you need to take care of. Okay. See, Sumit, if not an 100% subsidiary company, then it is the transfer would be chargeable to tax, and whatever price you have paid for it to purchase it would be your actual cost. Otherwise, see, asset transfer maybe when it is from holding to 100% subsidiary, they pay the price, but it is not considered. They pay the price, but it is not considered. What is considered is the cost which would have been continued had this would have been the same company. But otherwise, if it's not a 100% subsidiary company, you will transfer it and you will take some paisa from them, you will take some price for them, that would be your actual cost. Okay, so last two types of explanation. One is your scheme of corporatization. How many of you understand what corporatization is? Now, I'll tell you a story about that. Now, many years back, all these stock exchanges were not formed as corporates, but they were formed as AOPs and BOIs as trust. Okay, so once they were converted into corporates, their entity comes as corporate, the recognized stock exchange. So this process of conversion of the corporates from AOPs and BOIs to a corporate now is called corporatization. It's called corporatization. So now, pehle the recognized stock exchange was an AOP, correct? Now the recognized stock exchange is a corporate. Now for that corporate, the actual cost will be the deemed amount which would have been regarded as actual cost had there been no such corporatization. Had there been no such corporatization, the same cost would be taken up now also. Clear? Now for 35 AD. 35 AD, obviously we will do in detail, but what does this 35 AD wala point says here? Just like scientific research students, under section 35 AD also you get 100% deduction of your capital expenditure. 100% reduction of your capital expenditure. But here, if you use it for some other business, if you use it for some other business, as in same, let's take this as an asset. This was an asset which I used for a specified business of 35 AD. Now this asset I'm using it for my some other business, for my some other business. What would be my cost of the asset for this other business? This would be the cost of 35 AD minus the depreciation for all these years which would have been charged had it been used for the normal business. If you do not get this point, do not worry, because 35 AD, once it get clear, this point gets more clear. But those who understand 35 AD, simple, see, when you claim 35 AD, you claim 100% deduction. But when you use that asset for some other business, whatever deduction you claim becomes your income. This will come, don't worry. And at the same time, the cost of the asset is the cost minus the depreciation which you would have claimed. Also the income here, also deduction minus net of depreciation comes. Okay, so this is your 35 AD wala part. Any doubt? So I see very less participation. Let me ask one question now. If you people do not have any doubt, this is altogether a general question of till what we have studied now. Tell me, I told you you cannot claim notional rent, right? If you are the owner of that building. Yes. But tell me, if Mr. X is a partner who has given his building to the partnership firm in which he is a partner, to the partnership firm in which he is a partner, XYZ, it says XYZ, suppose. Okay. Now, can this partnership firm claim the rent? Because owner is one of the partner. Can the partnership firm claim the rent? Now, let me just break the monotony and get you back to the answers. Can this partnership firm claim the rent? Quickly. Think. Can this partnership firm claim the rent amount? Yes, Sumit, yes, you're right. Yes, firm can claim the rent because both are different entities for the tax perspective. The partner is different individual and the firm Mrs. XYZ is the firm, so that is not a notional rent at all. Okay, so such types of case studies can come and it will only be solved when, and these are very plain, but when applied the concept, things become a khichdi. So these can only be solved when you people have a clear understanding. Okay. So on this note, to make you people more active, any questions from explanation 40, section 43, all the explanations, anything you want to revisit, I can do it again. But meanwhile, if others do not have any doubt, please focus on the screen. There's a question on your screen, and I want everyone to answer, because if you can answer this question, that means yes, the doubts are clear, the concept is clear. Illustration of the question is on your screen. I want the whatever the question says. The question says you have to tell for the I'll you have to tell the depreciation for the year, and when we say depreciation, section 32 is your no, section 32 covers depreciation, my normal depreciation, my additional depreciation, all these depreciation are covered in my section 32 itself. Okay, so quickly tell me what would be the depreciation amount total, and if you can tell me how many blocks would be there and how many there should be two blocks. I myself have told this. Tell me the depreciation amount for the year. And only 4 minutes you guys have. I'll be quiet and you will tell me the answer. Okay, so let's see how many of you have actually answered it. I gave you enough time. Come on, students. What is the correct answer? If you can solve this question, that means depreciation has been clear. Another 1 minute. Quick. Guys, quick, quick. And I want person specifically who did not give it correct in the first time to give the correct answer now. Sumit, Gomati, everyone, quick. Savita. Now I'll start naming. No, no, no. Okay, so quickly, lights and power engage in the business of generation of power. First thing, as soon as generation of power, you have to take additional depreciation. Uh, Computer depreciation for the previous year of 2020-21, the written down value is given. The company has opted for depreciation on written down value. Now, written down value, it is written. Just in case it is not written, you will write it as an assumption that we are assuming it is a written down value. Opening WDV 578. First of all, there would be two blocks, one of 15%, another of 40%. In 578 wala blocks mein, you will add this 2 lakhs, then you will add this 8 lakhs, you will add 3 lakh air conditioner, and then you will add this 3,25,000. Another block of 40% may you will add this air pollution equipment, which is 40%. Your what is that's it? Yes, air pollution equipment 40%. And then there is an asset sold of 3,10,000 of the opening WDV. You do not have to think about these figures that how much was the cost, how much was the WDV when you are not into the balancing charge. Okay. So now you calculated your plant and machinery return on value on which the depreciation would be charged. Now on this 2,50,000, it's a plant and machinery 40%, but this air, where is this? Air pollution equipment was acquired and installed on 31st July 2020. So full 40% would be allowed here. Now on this normal depreciation is 578, may say 3,10,000 on that remaining. Then in the second hand machinery of 2 lakh, you will apply the depreciation of 15%. On this machinery, you will apply 8 lakhs per, you will apply, 2 lakhs per, you will apply 7.5%. 8 lakhs per, you will apply 15%. Air conditioner pay, you will apply 15%, and 3,25,000 pay you will you will apply 7.5%. Now coming to additional depreciation. Additional depreciation would be there on the asset only which are acquired and put to use during the year, not on the opening and not on the second hand. Second hand pay you will not get. Machinery YP you would get 8 lakh ka 20%. Then on air pollution equipment also you will get 2,50,000 ka 20%. Do not do 40%. New air conditioner which is installed in office, you will not get the additional depreciation, and on machinery Z you will get 7.5%. Any doubt? I don't know why you people did not answer it, because again, the point is of encouraging participation, and if that does not come, it would be very disheartening. So total depreciation is 15% of 4,37,075 rupees, and other car is your 1,50,000. Total 5,87075. Kunal, good for trying, but just see where the error has happened. Others who did not answer, I hope you did get the answer right. The class is not over. I really wanted to break the monotony. Now we'll come to some other concept. Okay. Next concept is of set off and carry forward. Now, students, set off and carry forward, yes, it's a different chapter, but depreciation altogether comes to your depreciation altogether comes in your section 32 itself. Section 32, subsection 2, your set carry forward and set off of depreciation. Ma'am, isn't depreciation a part of business? Yes, it is a part of business. Now, suppose if you have a business loss during the current year of 4 lakhs, in which depreciation which was charged was 2.5 lakhs. Now, as per income tax, what will you do? Your business loss, which would be carry forwarded, or business loss actual would be 1.5 lakhs, and your unabsorbed depreciation with the name will go as 2.5 lakhs. Okay. Section 32, subsection 2 says so. The unabsorbed depreciation and business loss. Now, as you may have a knowledge, business loss has a time period of set. First, whenever the loss is incurred, you set it off in the same head. If it is not set it off in the same head, then you go to other heads to take the help from. Okay? If it is not set it off in the other heads, then you carry forward it, and in the year of carry forward, after once it carry forward, it gets set off in the same head only. It gets set off in the same head only. Okay. Now, but what will happen? First, when this 4 lakh ka loss incurred in the current year, you will divide it. You will first set off your business loss, then you will set off your unabsorbed depreciation. Why? Because business loss has a timeline of being set off, which is 8 years max. If it is not set off within 8 years, it will lapse. It will lapse. But unabsorbed depreciation, on the other hand, can be set off till eternity. That means it can be carry forwarded for indefinite period, can be carried forwarded for indefinite period. That means even if your business for which you were incurring this unabsorbed depreciation, which you incurred this unabsorbed depreciation, is over, is closed, now you're running some other business, then also you can set off this unabsorbed depreciation. Then also you can set off this unabsorbed depreciation. So this is what the concept of unabsorbed depreciation goes. But if I talk about in pure business sense, how will you set off now in the next year? Now in the next year, first you will set off the current year depreciation, whatever the current year depreciation is coming from the current business income. Then you will set off this business loss, and then you will set off this unabsorbed depreciation. Is it clear? Yes or no? This is the order of set off. And Supreme Court has also ordered in the case of Mother India refrigeration that first the weightage should be given to current year depreciation. So let's take an example. Profits and gains from business and profession of Mr. X of previous year 1920 before charging depreciation is 20 lakhs. Of 20 before charging depreciation of 20 lakhs under section 32 was 16 lakh. Profit before charging depreciation was 16 and depreciation was of 20 lakhs. In such case, after setting off the depreciation, the unabsorbed depreciation for previous year 1920 would be 4 lakh. If profits and gains from business or profession for previous year 2021 before depreciation is 11 lakhs and depreciation allowance under section 32 for the said previous year is 5 lakhs. Now we come to the next year where profit is 11 and depreciation is 5. Then the unabsorbed depreciation would be added to the depreciation allowance. The unabsorbed depreciation of 4 lakhs would be added to the depreciation allowance of 5 lakhs. Consequently, 9 lakh would be allowed to be set off with the profit of 11 lakhs and the taxable profits would be 2 lakhs. Had this would be the case that the current year depreciation would be 7 lakhs. So first you will set up the current year depreciation and then the previous year depreciation would be set off. Or say this profit would have been 10 lakhs. So first you will set off the current year depreciation, then from the remaining 1 lakh profit, the previous year, the unabsorbed depreciation of 3 would be set off and then 3 lakh would be the unabsorbed depreciation. Any doubt, students? Okay, so abhi tak I understand that you have got the idea of how the things work. Actual cost we have discussed. Written down value is actually your homework because written down value is more or less to be understood in the same lines and we have discussed a lot of it. Basically, you have to have in hold of succession. Your succession, you're transferring to amalgamated and amalgamating company, your block of assets for demerged and your resultant company. This you will do, read it and will come as a homework because and you will do all the questions, so probably the one we have discussed and the one which are there in your exercise, and you will definitely if you do not have the current year module, please practice it from the previous year module because as in depreciation there is no such change apart from additional depreciation of 35%, there is no such change. There was used to be a concept of investment allowance under section 32 AD, but that was also up till 31st March 2020, so it is not applicable for you. That you can choose to ignore. Any doubts? If you do not have any doubts, I will ask question, or if you want to refer, we can start a small topic and wrap it up. Whatever choices of the house. Any questions? Yes, no, clear, yes, no. You want to start a new topic, a small new topic, and we covered and finished? Or maybe not. Totally on your choice. Any particular doubts? You want me to do one more question? You want an example of some particular depreciation, additional depreciation, balancing charge, anything? Okay. So I believe the depreciation concept is clear to each one of you and you will practice. Achha, you want one example on depreciation. 1 second. On you guys, just 1 second. One second, students. Question is here. Okay, on your screen, guys. But I want everyone to participate and answer, then only it would be fruitful. You have to compute the quantum of depreciation available under section 32 in respect of following items of plant and machinery purchased by PQR Textiles through account page check. Just in case students, again, account page check is not written, you will write the assumption that we are assuming that everything is paid through account page check. Otherwise, your whole answer will not hold good. It is engaged in manufacturing of textile fabrics. Assume the company do not opt for 115 BAA and BAB. So this is the knowledge of plant and machinery. You have, it is in manufacturing business. Calculate and tell me the depreciation and WDV as on 1st April 2021. Quick. Depreciation and the WDV. I'll just give you 1 minute to absorb the question and then I'll start discussing it. Okay, so new machinery installed of 84 crores. Then new windmill purchased 18 June ko 22 crores. Then windmill pay depreciation would be at the rate of 40%. Your plant and machinery, computers installed on office premises, computer installed in factory 40%. Lift trucks used inside factory, purchased on lorries again 15% put to use on July 2020. Computers installed new imported machinery 12 lakhs, which was installed on 3rd April and 2021. Now, what would be the depreciation? On 84 and the lorries, because lorries are also 15% and are the same asset. So 84 plus 3, 87, you will give the depreciation for full year. Then on 4 crore, you will give the depreciation for 180, less than 180 days pay, 7.5%. Clear? Then on the plant machinery of the computers, two computers were used, one for office and one for factory. Both were installed after 30th November, so 3 crore pay, you will give 20% as your normal depreciation. Then windmill pay 40% you will give, but full you will give because it was installed and used for more than 180 days. So full 40%, which would come as 22 ka 8.8. Any doubt? No. Now on the additional depreciation. Additional depreciation would be on the new machinery installed of 84 crores, but it would not be given on road vehicles. Remember? Yes. lift trucks used inside the factory. That is not a road vehicle. It's like to transfer the parts or products from one part to another. You use lift trucks like a crane. Uspe you will give additional depreciation. 84 pay you will give full 20%. 4 pay you will give 10%. Computers installed in factory pay you will give full 10%, but not in the one which are installed in the office premises. Windmill pay again you will give full 20% depreciation. Any doubt? A depreciation available total is 44.55 crores, including additional. And the WDV would be for block 1 would be 72.45, which is of 15%. Of 40% block, it would be 11. And this is the way you have to represent your questions also. Windmill and computers, so guys, there would be one block because for plant and machinery, yes, same class, yes, same rate, 40%, yes. So one block. Do not make 3 blocks and make an error here. किसी को इसमें any doubt? Kunal? Never ever do any question like seeing the solution. This is not the right way to do, at least for the first or the second time. Always do it, apply your senses, apply your concept, and then move ahead. You may be right, you may be wrong, but then you will know that what you are lacking at. If you will see it and do it and you will say, ho gaya, maybe you find 1 or 2 point extra, but that would not result in something fruitful. That would not be a result of something fruitful. I'll again say. So this class we have ended with depreciation topic. In the next class, slightly technical topics will begin in relation to your tea, coffee, rubber development, your scientific research, and we'll try covering your 35 AD, your telecommunication, and small topics. Okay, so that would be the next class, which would be covering some specific types of reductions available to some specific types of businesses. Okay, see you in the next class. If you have any doubt, you can write it, or you can join early in the next class, because every time we'll do a drill for 2 to 5 minutes. Discussing your question. Explain HP. Leela, what do you mean by HP? Hyperj's the question you want? Or here on this particular thing you have any doubt? Others, you may leave because this is all. So I tried covering maximum examples, but again, I'll push on the advantage and on the importance of self-study after the class. Okay, so let's meet you all in the next class. Till then, please take care, stay safe, and please study. Thank you.